Welcome back to Realty Solutions, your go-to source for real estate insights and advice. Today, we're diving into a critical topic that can make or break your real estate investment journey. We're talking about the common pitfalls to sidestep when venturing into this exciting yet challenging realm. From the seasoned professional to the greenhorn, there's something for everyone to learn. So let's get started on this enlightening journey to help you navigate the hurdles and achieve success in the market. First up, it's failing to do your research. Now, you wouldn't dive into unknown waters blindfolded, would you? Similarly, investing in real estate without thorough market research is akin to diving blindfolded. It's crucial to understand the local market trends, property values, and demographics before making any investment decisions. Think of it as a treasure map. You wouldn't start digging without knowing where the X marks the spot, would you? The same applies to real estate investing. With thorough research, you're marking your X on the map, identifying where the potential treasure, or in this case, profitable investment, lies. Diving deeper into local market trends, you'll want to understand if the area is on the rise or if it's stagnant. Are businesses flourishing? Is the population growing? What about the local economy? These factors can significantly impact property values and the overall potential of your investment. Next, consider property values. Are they on an upward trajectory, or have they been declining over the years? Understanding this will give you a sense of whether your investment is likely to appreciate over time. Lastly, don't overlook the demographics. Who lives in the area? Families, young professionals, retirees. The demographic makeup can influence the type of property that's in demand and can guide your investment strategy. Investing in real estate without thorough market research is like diving into unknown waters blindfolded. So, do your homework, gather your data, and create your treasure map. This way, you're not just investing, you're investing wisely. Next, we have over-leveraging. This is a common pitfall where investors take on more debt than they can comfortably manage. It's like trying to juggle too many balls at once. Drop one, and the whole act can come crashing down. The allure of leveraging is understandable. More capital means more property, and more property can mean more profit. But remember, it also means more risk. With every dollar borrowed, you're increasing your financial obligations. Picture it as a scale. On one side, you have your debt, and on the other, your assets. The heavier the debt side becomes, the more precarious your financial position. And here's where a buffer comes into play. A buffer is your safety net. It's the cash reserve that can save you from toppling over when unexpected expenses hit or market downturns occur. So, be conservative with your leverage and ensure you have a buffer for unexpected expenses or market downturns. Now let's talk about underestimating expenses. When you're investing in real estate, it's easy to get laser-focused on the purchase price of a property. It's a big figure, it's right there in front of you, and it's often the number that lenders and agents talk about the most. But it's only part of the picture. There are ongoing expenses that, while they may seem small in comparison, can add up over time and significantly impact the profitability of your investment. We're talking about things like maintenance costs, property management fees, and taxes. These are the stealthy expenses that can sneak up on you if you're not careful. And don't forget about potential unexpected costs, like major repairs or vacancies. These can throw a wrench into even the most well-planned budget. So when you're calculating the potential return on an investment property, always factor in these costs to accurately assess the profitability of an investment. Another common mistake is neglecting due diligence. This is a critical step that can't be brushed aside or rushed through. Due diligence is your safety net, your safeguard against unforeseen and potentially costly surprises. It's your opportunity to really get to know the property you're considering and to uncover any hidden issues. It involves inspections, title searches, and legal checks. Inspections give you an idea of the property's condition, revealing any potential structural issues, needed repairs, or code violations. Title searches ensure that the property is free from liens or ownership disputes. Legal checks verify that there are no zoning issues or legal restrictions that could impact your plans for the property. Neglecting due diligence can lead to financial headaches and legal issues down the line. It's not worth the risk. So before you sign on the dotted line, take the time to conduct thorough due diligence on every investment property. Next, it's chasing trends without a strategy. This is an enticing trap that many fall into. The allure of the latest real estate craze, be it flipping houses, investing in short-term rentals, or enraged buying into the newest up-and-coming neighborhood, can be hard to resist. It's shiny, it's new, and everyone seems to be doing it. But what works for one investor may not work for you. Without a solid investment strategy, you're essentially gambling, not investing. And remember, the house always wins in a game of chance. So before you jump on the latest trend, take a step back. Ask yourself, does this align with my investment goals? Can I afford the risk if this trend doesn't pan out? Do I have the necessary knowledge and skills to make this work? Your investment strategy should be as unique as you are. It should reflect your financial goals, your risk tolerance, and your understanding of the market. It's not about what's hot today, it's about what will help you achieve your long-term goals. So don't chase trends. Instead, develop a clear investment plan based on your goals, risk tolerance, and market expertise. When you have a well-thought-out strategy, you're not just following the crowd, you're paving your own path to success. Lastly, we have letting emotions guide your decisions. It's surprisingly easy to let our emotions take the driver's seat, especially when we're dealing with something as significant as real estate investments. A property might tug at your heartstrings, reminding you of your childhood home, or you might feel a rush of excitement at the prospect of a quick profit. But remember, real estate investing is not about chasing feelings. It's about following facts and figures. When emotions are in control, you might overlook critical flaws, overpay, or jump into a deal without proper due diligence. Remember, a successful real estate investor is not swayed by emotions, but steered by a well-researched strategy and clear investment criteria. So how can you keep your emotions in check? First, always remind yourself that real estate investing is a business, not a personal endeavor. You are not buying a home to live in. You're investing in a property to earn a return. Second, practice patience. Real estate investing is not a get-rich-quick scheme. It's a long-term game that requires persistence and discipline. Rushing into decisions can lead to costly mistakes. Third, trust the data. Base your decisions on solid market research, financial analysis, and due diligence. If a deal doesn't align with your investment criteria, walk away, no matter how much it appeals to your emotions. Stay objective, stick to your investment criteria, and remain disciplined in your approach. Avoiding these common real estate investing mistakes can save you time, money, and headaches in the long run. We've journeyed through the pitfalls of failing to do your research, the dangers of over-leveraging, and the risk of underestimating expenses. We've also highlighted the importance of not neglecting due diligence and the perils of chasing trends without a strategy. Lastly, we've explored the consequences of letting emotions guide your decisions. Just remember, real estate investing is a business. It requires a clear strategy, thorough research, careful financial management, and a level-headed approach. These keys will help you navigate the treacherous waters of real estate investing and lead you to the shores of success. Remember to subscribe to Realty Solutions for more valuable insights and tips on navigating the world of real estate investing. Thanks for watching, and happy investing!